and welcome to the Investors Management Group webcast presentation for first quarter 2020 for Livingston at Laurel Hills. We appreciate your participation today. Our goal of today's webcast is to present a high-level performance update on your investment with us. We value our role as your asset manager, and we hope that today's conversation surrounding Livingston delivers useful information for understanding your asset and the current market environment. The hosts of today's webcast are Carlin Conklin, an IMG Principal and Executive Vice President, Michelle Hrivnak, Managing Director of Asset Management, and myself, Dave Mickelson, Investor Relations Manager. Also on the call from IMG is Andrew Schoaf, IMG's new Senior Asset Manager. Prior to joining IMG, Andrew held the position of Regional Property Manager with Pinnacle Property Management, where he oversaw a portfolio with over 1 million square feet. He recently arrived to Portland from the Twin Cities and is already making big contributions to our asset management team. So we extend a warm welcome to Andrew, and we're pleased to have him with us. Today, we will be presenting a review of what we've achieved for first quarter 2020 operations, as well as updates on capital improvement projects and owner reserve balances. Additionally, we'll be focusing a large part of our discussion on the economic impacts of COVID-19, including what we've experienced in April at the property level, what we see industry-wide, and how we're navigating for the future. I'll remind everyone of a few features for our presentation. First, all the participants will be in listen-only mode. For those joining through the web, I encourage you to submit questions through the live chat pane. You can click that chat bubble and send your message to either the organizer or to everyone. For those not on the web, feel free to send questions to me directly at david.mickelson@imgre.com. I'll be collecting questions during the presentation, and we can address those during the question and answer segment at the end of the call. With that introduction, I'll turn it over to Michelle to review Livingston first quarter performance.
Thank you, Dave, and hello, everyone. Thank you for joining us today. I will be taking us through a high-level review of our Q1 2020 budget numbers compared to our actual performance, and then talking about any of the main drivers that are leading the variances. So let's start at the top. If on our slide, you can see our net potential rent. We were budgeted to bring in $573,694. We have a 0% variance there, so our actual number is right on track. Our next line down, we can see $32,477 negative budgeted for rent adjustments for the quarter. Now, rent adjustments are going to be concessions and any bad debt or vacancies that the property is going through. So you can see that our actual number was lower, and that's mainly driven by our occupancy, and we are also $2,000 to the good on any sort of bad debt. So the property has been performing very well on that aspect. Rolling into our net rental income, our budgeted amount is $541,000 for the quarter. We came in at $547,000. So we have a positive variance there of $6,000 or 1.1%. Looking at our other income, we exceeded expectations there as well. We were budgeted to collect $39,000. We collected $43,000 for a favorable amount of $3,676 or 9.3%. All of that rolls into our total income. We were budgeted at $580,000, came in at $590,000. So we've got that comfortable $10,000 cushion built in, 1.7% for our income for Q1 for Livingston. Now, if you look to our operating expenses, we've also done really well here compared to budget. While this property is new to us, our management company is not. We've worked with them. And we've got a very experienced manager and maintenance supervisor on staff. You can see that they are really looking at their expenses. We were budgeted for $244,000, and our actual spend was $220,000. So we have a 9.7% positive variance, right about $24,000. All of that rolls into our net operating income. Our net operating income budgeted for Q1 was $336,725, but our actual is higher at $370,000, again showing a positive variance of 10% for the quarter. I do want to briefly touch on our debt service as well. That was budgeted $188,000 for the quarter. It came in lower, $179,000. So an additional $9,500 cushion of positive variance that we've got built in there, or 5% for a debt service for the quarter. So that just kind of gives you an idea of our property, what the operations are doing our first 3 months. Things are going very well, operating to budget, exceeding some expectations. So things are looking good. So far, so good for Livingston. From there, I'd like to take you to a different look at our reserve summary. So we did just close Livingston in December, so we have a lot of reserves, and I'd like to kind of walk through so you can see the difference of what is lender held versus what is owner held, what we can use, and kind of walk you through these bigger numbers. So we've got an operating account that's sitting with $115,000. We also have a capital reserve account with $725,000 and a depository account of $548,000. So combined on an owner-controlled reserve amount, it's $1,388,000. Now, some of those funds are earmarked for projects that we've got in play right now, and up and coming projects. So we'll walk through that in our following slide. But if you look at the bottom of this information, you're going to see our capital reserves that are lender held. So we can back up that slide actually. There you go. So our capital reserve, we do have a large amount there. It's at $1,391,000. So that is a large account held by the lender, and that's where our bigger projects are coming in. The lender is holding that. We have to spend the money, and then we submit a draw to get reimbursed, and that's how we're able to access that money through the lender. Additionally, there's a replacement reserve account that works the same way. That account has $185,000 in it, and they're specific as to which items we're able to draw on per each of those accounts. Now, we do have a few other items with the lender. We've got a real estate escrow account at $58,881, an insurance escrow account at $16,457, and an interest rate cap at $1,000 balance. So our combined lender reserves is $1,652,000. And if you add that to our owner reserves, we have a very healthy amount of $3 million sitting for reserves, both lender and owner held at Livingston. So that's where we'll go into our next piece of information for a capital overview. And I know I've got a ton of information here for you. But I think that this is maybe one of the first calls that we're having for Livingston. We really wanted to walk you through how we onboard a property, what the capital expenditures look like, what that budget is like. And then now, as we're in our kind of COVID universe, how we're looking at that spend and deciding how to do things in projects. So we do have a laundry list of projects, and looking forward to getting all of these completed. We do have, I'd like to highlight just a few. Now, we do have a retaining wall. Our budget there is it's $145,000. That is something that we do need to finalize for the lender. It is one of their items. And we have been looking into it. We do have contracts ready for it. However, when we were just about to pull the trigger, that's when we ended up in this new environment with moratoriums and non-essential workers not being able to go to work. So what we did not want to happen was to start to pull apart this huge retaining wall, and then no one's allowed to go back to work. So we wanted to definitely wait on projects like that and some other specific projects that you're not able to set down and come back to, the retaining wall being one of those. So we do have the contractor ready. We've looked at a mobilization payment, and we're just waiting until we kind of get to the other side of COVID until we can pull the trigger and actually get those types of things done. Now, when it comes to some other projects, we have moved forward. We're finalizing the exterior woodwork and painting contract. That's more of an asset preservation project. So we definitely want to do that for the health of the building. And again, woodwork and painting, that is something that you can set down and come back to. Other items that we're not going forward with at this very moment is, say, clubhouse and fitness center upgrades, as those locations are currently closed to prospects and residents at this time. So we definitely want to make sure that we're getting the lift and we're getting the financial benefit from doing those. Now, that's not to say we're not doing any work at all on the backside. We're looking at design, we're talking to contractors. We just have not pulled the trigger on those types of projects yet. So like I said, it is a long list of things that we have upcoming. And as we go through these webcasts, I will be giving you updates on these projects and how they're going, and as we decide which triggers to pull. When it comes to our interior unit renovations, we did one mock-up unit, and I like the scope. I think it's going to go over well. And we finalized that scope about 3 or 4 days before the whole country kind of went on lockdown. So we're holding on doing those types of upgrades right now. We are replacing, we're doing turns, unit turns on as they vacate, and we are upgrading them. So you will see some spend there, but we're trying to keep that in tied with how much rent lift we can get in this market. So the property is operating well. The staff has been a really great team that we've seen. They're developing a really good relationship with the community. So all of those things are going well. And then as we get kind of to the other side of COVID, we'll start to pull the trigger on some of these bigger projects. But we have COVID kind of to battle with right now. So I'll go ahead and send it over to Carlin, and she can talk to us about the different laws and those changes and how they are actually impacting our decision making at this time.
Thanks, Michelle. Livingston's a little different than many of the other properties in our portfolio, because what happened with Livingston is we closed it in December. We typically hold distributions for the first 3 months of ownership, and then we start after 3 full months. So we were to start distributions for Livingston this month, but we curtailed that along with our entire portfolio. The takeover on Livingston has been one of the best takeovers that we have done. I'm sure a lot of that has to do with Michelle and her relationship with the property management company. I mean, it's just been stellar. And that's one of the reasons those accounts have so much cash in them. With Livingston, there's a couple of programs. So I'm sort of shaking things up a little here, but with the CARES Act, there's both programs for owners as well as there's programs for the residents. Right now, things are looking really good at Livingston. It's in a fantastic location in Raleigh, and yet we don't know what's going to happen as we move deeper into lockdown or shelter in place, and there's some fairly substantial economic implications going on right now too. But with the I'm going to start from the bottom, so I'm going to shake this up because I know a lot of you have been on many of these webcasts in the last 2 days. We'll start with the bottom on this one. The payroll protection, we don't qualify, and we probably don't need it at this time anyway, but we don't qualify for that. The eviction moratorium, of course we do, because we have a Freddie loan. So at this point in time, we cannot evict, we cannot charge late payments, And so as Michelle and I tag team on this, and I talk about, well, we don't have the stick anymore, she always talks about the carrot and what can happen with individual relationships with residents. So given that GDP fell 4.8% annualized in the first quarter, most of that was due to March. We know that April is worse. We do not know what's going to happen with May. We are going to be monitoring Livingston as we are doing every other property. So with Livingston, for the residents, again, it's like every other property with a Freddie loan. We need to do the carrot approach. Talk to them about unemployment because the federal unemployment benefits are kicking in. Those with student loans, they're having them deferred. All of those things that are going to help residents. If we go to the next slide with loan forbearance, at this point, there is no reason for us to even consider forbearance for Livingston. The loan is an exceptional loan, interest only for 5 years more. And then 5 years after that, it amortizes. But it seems like 5 years is so far in the future when we are all right now focused on day to day. So forbearance on this program is not an option. It's not even something that we are considering. And we will be monitoring all this property along with all the others as we move forward. So so that's the forbearance. I am next moving into the sensitivity analysis. So those of you that did listen in on our COVID webcast on March 19th, if you were able to attend, that's great. But for everyone, that webcast and transcript is in your portal. But with Livingston, along with our other properties, what most of our investors care about is there likely to be a capital call with Livingston? No. And where is the break even? So Dave now is going to talk to you about our analysis on Livingston, and we have less information than we do with other properties, but it's pretty sound information, and he'll talk to you about the break even on this property. So Dave, floor is yours.
Thank you, Carlin. So like Carlin mentioned, as we moved into this COVID affected period, really we wanted to establish some kind of parameters that we were operating within and able to measure against in terms of how we were collecting income and where that would put us in, relative to break even, to pay the debt, et cetera. So as our approach in doing that, we created these sensitivity analyses with different tests. And our first step in that was to really create kind of a benchmark, what we'd call a standard income and expense assumption. And you'll see that in our column on the left. We've taken our average income for the last 2 months and our expenses according to our budget, which are also based on actual expenses from the property in prior year, and kind of set up what we'd consider standard operations or what we'd expect to achieve if there were no economic impact. From that, we ran a sensitivity test 1. This is the middle column, which we're calling break even. And in this scenario, we calculated to find what kind of drop in collections could the property bear and still break even and pay debt service. So you'll see highlighted in the blue row this line that says additional deduction to total collections. This percent, which is 27%, is the amount that we believe the property could lose and still have sufficient income to pay its ongoing expenses and debt service. So at a 27% income loss, we are collecting 73% of our average net collections based on prior months. That allows us to pay our operating expenses. And as you go down that column, you'll see we've made assumptions for what the debt service rate would be. And I'll get into more about that in just a minute. But you'll see that's at 3.21%. That's substantially below where we were projecting debt to be when this project closed about 4 months ago, which was about 3.91%. Then you factor in lender impounds, escrows, and reserves. We balance for that, and the property breaks even kind of right in line with that assumption with a 27% reduction in collections. In the column on the far right, we ran a kind of extreme case scenario as to what would happen if the property were suffering from a 50% collections loss. And so as you move down that column, you'll see that, we lose 50% of income. We're still paying our expenses, our debt service. And in that scenario, our cash flow deficit per year is about $520,000, and our cash flow deficit per month is about $43,000. So as we move to the next slide, I'll kind of give some more background on the assumptions that we made as we prepared this model and what that means to us going forward. So in the first two bullet points, our property break-even point is 73% of collections. That allows for a combined 27% reduction in our aggregate rent collection and other income collection, and still break even. For our operating expenses, we made a couple slight adjustments that we felt were necessary for really kind of being conservative and sizing up the situation here. Number one, we increased our utilities expense by 20%. That's to account for more residents being at home, whether they're working from home or quarantined or have less employment hours and are spending more time at home. That's kind of a conservative approach we took with utilities. Then number two, our property management fee, that has a floor. So our fee is a greater of 2.75% of revenue or $4,000 a month. So as income collections drop, that property management fee drops as well, but then it stays at a minimum at $4,000 per month. Third, our asset management fee, that's a fee that's directly tied to gross revenue collection, and that's purely a percentage. So again, as our income collections drop in the break-even case or the 50% income collections drop scenario, that asset management fee drops as well. One, I think, really favorable point and a conservative approach we took here with this sensitivity test is in our mortgage interest assumption. Our loan here is indexed to the 1-month LIBOR rate with a margin of 2.21% applied on top of that. So when we put this analysis together, we assumed a 1% LIBOR rate was conservative. I think rates at that time were in the 0.75 range. Since then, really working in our favor, those LIBOR rates have dropped to a year, actually the yearly low yesterday of 0.37%. So we've gained a lot of cushion as that LIBOR rate has dropped, because that's clearly going to affect our debt service expense, which is our biggest expense. And as that debt service expense drops, that kind of gives us more latitude and flexibility, even with that break-even scenario. So I'll pass it back to Michelle, and she can kind of talk about how we're using the break-even to compare against the collections that we've had in April, and how we'll do that going forward.
Sure. Thanks, Dave. So tying that information back into Livingston and our April performance, we can start with April rental income billed. Now that is in the amount of $184,639. So that's only rent that we've billed to the residents, and what we've collected of that as of April 24th, collected $176,700, which is 96% and a very solid number. Our other income collected is $10,828. That is your pet fees or lease termination fees, all the other utility reimbursements, everything that would go along with rent. Those two numbers combined takes us to our net collections. Our net collections are at $187,528. And that's the number that we're comparing to our break-even analysis. The break-even number is $143,000. So that means for April, we have a $44,488 surplus, or we are at 131% of our break-even number. And when you look at our physical occupancy, we're occupied 95.7, 96%. So the property is faring very well. As our transition over from in-person leasing to virtual leasing, this site transitioned quickly and very effectively. So leasing has been going well over there. Now, when you look at payment plans, we do have 9 payment plans with folks. In our normal course of operations or business, we wouldn't necessarily allow payment plans. Again, Carlin has with the stick and if I'm the carrot. She mentioned that we're, in this CARES Act environment, we can't evict, we can't do late fees. So we just took this as an opportunity to become very flexible on payment plans. Our site teams are working with each resident that has been financially impacted, and we are customizing payment plans to something that they can perform to. And this benefits us in 2 ways, really. It maximizes our ability to collect rent throughout the entire month, and it also it keeps our residents engaged and helps to build that sense of community and relationship, keeping the site team as a resource for the residents, but also knowing that rental obligation for them is in the front of mind. So that's where we're at with payment plans so far here. We've also we're also tracking our month to date total collections versus the trailing 6 months. So we're really in line with that. We're at 96% of collections for this 6 months versus last. So our trending is pretty solid here. We do see a line saying our surveys are generally anticipating May collections to fall below April collections, and obviously due to the rising unemployment. And I do agree with that. I also think we're just going to see different trends in how we collect rent. We have 9 payment plans now, and I can see that number climbing a little bit. As people were coming out of March, getting into April, they were ready for those rental payments, and unemployment certainly surged from the end of March into April. So I think we'll start to see more payment plans and more people kind of needing to pay on a weekly basis, especially if there are resident percentage that are impacted by unemployment, and they're waiting on those kind of weekly payments in order to pay their rental obligation. So I think we're going to see that increase. We don't have enough trending information for to give you anything definite yet, but there is just a lot of data to analyze and news to follow about how unemployment is being, how it's being funneled and approved and sent out to our residents in North Carolina. So you'll see the unemployment is run state by state, and some states are faring far better than other ones. And North Carolina is somewhere in the middle. They are getting their unemployment out. They're behind on this new group of folks that are independent contractors. Those folks weren't necessarily covered under unemployment before, but they are now during the CARES Act. So they've only become eligible to apply through the state websites as of last week. So we had about 50,000 to 80,000 new claims go through on the contract workers to get their unemployment out. So the way it works is all of these people need to go through the state submission process and be approved before they can get their state level unemployment. And then the second part of that process is when they go through and are approved for the additional 600 weekly, which is federally backed. So it's a bit of a process, and they're moving through it. And as we get more information, we'll definitely be tracking this through May. Right now, we're tracking it daily. We're looking at all of every property, every front door, who's paid and who owes. We're also monitoring the payment plans and seeing how that's working. We're involved in the approval process there to make sure payment plans are reasonable and that residents would be able to perform to them. And then we're reviewing on a weekly basis how well those payment plans are going. So we are definitely involved in all of the news and the unemployment rates and how all of that is working for our residents at Livingston. And I think we will have an additional webcast for you at the end of May. That will provide us enough time to sort through the trending and get more detail and clarity on the topic. So we'll be able to provide that to you, as well as kind of a 2020 reforecast or budget reforecast to see how these changes are going to impact what we originally said the operations were going to be. So I know that's a lot of information, but I do want to touch on one other topic. When it comes to payment plans and collections, it's just vitally important to understand our demographics and know where are our people working and are they working. So this information for you here shows that 70% of our residents are employed in occupations that are far less affected by COVID-19. Our household income, you can see, is easily picked through at the $30,000 to about $70,000 range. And that's a very solid number for our rental amounts that we have at the property. If you look at our pie chart, you can see that 49% of people are in professional services. We've got military and government. We also have skilled labor. So these residents are still working. And if they're not working at their jobs, they're able to work from home. So that adds another level of stability to the property in what I foresee coming up in May. And then we've got our all other folks, and they're going to be your service industry, maybe truly impacted by restaurants closing or shopping centers, malls, and things like that. So we'll walk through this, and we're checking it every day, and we'll have some more information, like I mentioned, at the end of May. So that's a lot of detail about the local market. So I'd like to hand it over to Dave so he can take a step back and give us an overview of kind of the national point of view.
Thanks, Michelle. So we've been talking more property levels so far in the call. I'll just take a moment to kind of zoom out and speak more of a national level and highlight some bright spots that support an optimistic perspective for Class B multifamily like Livingston. So just to highlight a few recent publications, this week Moody's Analytics published its first quarter 2020 report, and they cover all of commercial real estate across the country. They note that, relatively speaking, multifamily should experience less distress than other property types, specifically when you compare it to retail, hospitality, and office. And really that Moody's conclusion has been the opinion of the general industry consensus through this downturn. A few data points support Moody's analysis. First of all, they underline the fact that multifamily vacancies have trended to near record lows given how well the sector's performed over the last decade. So as of today, we're starting off from a lower vacancy rate in this cycle at just under 5% relative to where we were in 2006, 2007, when vacancy was already approaching 6% and growing in response to the housing market bust. Second, the Moody's Analytics forecast models some balancing effects like a decline in new construction as a response to the economic slowdown. So in Moody's scenario, the 300,000 units of new apartment supply that's in the pipeline at the national level is cut in roughly half, and though vacancies rise in their forecast, the drop in new supply supports occupancy levels quite a bit. If we look at multifamily industry-specific reports, such as those coming from Multifamily Biz and Multi-Housing News, they point to Class B apartments as being the best defensively positioned apartment type. The reason for that is that Class A renters are more mobile and likely to move to other housing locations or to housing that's more affordable, while Class C renters tend to be most impacted by the rising unemployment, and they have lower reserves of savings to draw from in an economic crisis. All this isn't to say that Class B product won't feel impact, but to say that our segment should perform the best relative to the other housing segments. Also, I'll point out, as Carlin covered in her Kiplinger article from a couple of weeks ago, the underlying fundamentals that have supported multifamily through this cycle are all still in place, and they should sustain demand for rentals as it returns in the long run. Additionally, Livingston, I think, has been structured conservatively and benefits from some terms within the deal that provide safety through this period. As Carlin pointed out, one of the biggest risks to any commercial real estate owner in a downturn is loan maturity. We don't have that occurring here for almost 10 years, so that's not an issue. In our loan, we also don't have high leverage or any kind of construction financing, so those risks don't apply to us either. Lastly, we're benefiting through the fact that it's a Freddie loan with a loan forbearance option. Although we don't have to use that, it's a nice option to use if we want to allow us to defer any kind of debt payment for 3 months. And then additionally, as mentioned, as interest rates drop, because this is a variable rate loan with no floor, we should benefit substantially from savings on those monthly debt expenses. As a last piece of relevant news, I wanted to bring up the IRS 1031 exchange extension. As you'd imagine, with buyers and sellers facing some real challenges to get deals done, the IRS has granted extensions on identification and closing date periods that go through July 15th. We're not sure yet whether that extension will be pushed further, but in the meantime, it does provide some immediate relief on that timing pressure. So as we move to the next slide and continuing the theme about 1031 exchange extensions, let me briefly present a property that we have in contract now that could be a potential exchange replacement or an investment candidate for you. We're in contract to acquire Apex Apartments, which is located in San Antonio, Texas. This property is 324 units, built in 1996, and really fits the perfect profile of our acquisition criteria. San Antonio would represent a new, compelling market for IMG, and we're excited to enter the Texas market. Just as a small recap of the property's physical history, current ownership has recently spent more than $2 million on interior renovations that covered about a third of the units and community upgrades. Prior to that, the property benefited from a full replacement of roofs, windows, and exterior doors at a cost of over $6.5 million. So we see good value in the price that we're in contract at $125,000 per unit. And obviously we're monitoring how values trend here with some of this market turbulence. Our investment strategy for Apex would follow the pattern that we've used across our portfolio, with a light value add upgrade, especially focused on unit improvements to keep driving rents. We've negotiated an extended closing window for the deal that runs through about September 1st. That'll allow us to get on site and conduct our due diligence as soon as we're able to do that. So if you're interested in more detail, please let Carlin or me know. We can send an overview package. We'll have more details we get further into that transaction. Well, that'll conclude our webcast slide presentation and lead us into our question and answer segment of the call. Again, to remind you, if you'd like to submit a question, you can do that in the chat pane, or you can send an email to me at david.nicholson@imgre.com. We've received a few questions so far, and we can also cover a few common questions that have come up with other investors that might be on your mind as well. So to begin the question and answer, let me send the first question to Michelle, and this goes back to our reserves slide if we want to scroll back there. So Michelle, how do we differentiate a depository account from a CapEx reserve account or an operating account?
Oh, okay. Good question, Dave. So the operating account and the CapEx reserve account, those balances are currently, they are still owner controlled, but they're in an account, the top two are in an account with the property management company, so that they can pay bills, regular operating bills, and as we need mobilization payments and whatnot for our vendors and contractors. The depository account is held by IMG, and that's simply because the property management company doesn't need access to all of that money at one time. So as their operating accounts or capital accounts are depleted due to work, then we would send them over money from the depository account to replenish those amounts. Does that answer the question?
Yes, very good. I appreciate that. So, Carlin, here's a question that wasn't asked on the call here, but has been brought up, I think, as a kind of a consistent theme, and that is with our owner distributions on hold, what will have to change for those owner distributions to start as kind of a best case, and as you kind of work down to a worst case, what would have to happen before we use the loan forbearance program? Can we draw from reserves to make payments, et cetera?
Sure, I'll take that one on. Livingston is very, very healthy. What's going to make a difference in our decision regarding distribution is what happens with collections the next 2 months. Livingston, so May is going to be, by most, analysts in the market, in the industry, there is concern about May and June collections. So what we're going to want to do is let's look at May collections. And if June looks like it is producing the same amount, Michelle's got payment plans, occupancy is high, rents are coming in, we can certainly look at starting distributions. We don't need to sit on a lot of extra cash unless that cash is a hedge against risk. So we will know more about Livingston when we get together for the webcast at the end of May. We'll be able to see, this is what May collections are doing. This is what Raleigh is doing. And then we'll be able to make a decision once we hit collections in June. So this one's a great story, great reserves, lots of cushion. And it would be months, if not to the end of the year, before there would be any concern about this property. And rent collections would have to go down significantly for many months before this property would want to even go into forbearance. So this one is more about let's watch it, and then let's make a decision as we know what the June collections are going to do.
Very good. Thank you, Carlin. Well, that'll conclude our question and answer segment of the call as well. And I'll extend the invitation to anybody on the call. If you have questions that come up in the future, don't hesitate to reach out to me or Michelle or Carlin, and we can answer those. Like was mentioned earlier in the call, our goal to keep you informed during this evolving market, we're planning to host a special update webcast at the end of May. And that'll be a presentation where we provide you with a recap of April performance, an update on collections for May, a 2020 recasted operating budget, and other updated news. So we'll send invitations to you for that May webcast when the schedule for that is final. Thanks again to everybody for your time and your questions today. We'll continue to prioritize the health of our residents and the performance of your investments through the COVID-19 impact.